welcome to the program. Today's JOLT report is a miss, signaling a softening in the job market and stoking fears of recession. We also have the yield curve un-inverting, also signaling, worries about a recession incoming. We have dollar tree dropping more than 15% here at the open after the release of their earnings. And let's have a look at all this worrying signal overall in the economy. Let's have a look here at CNBC talking about this JOLT report. Job openings fell more than expected in July in another sign of labor market softening. And below, you can read the bond market yield curve returns to normal from an inverted state that has raised recession fear. Let's have a quick look here at the JOLTS article, and let's see what they say here. Job openings slumped to their lowest level in 3.5 years in July, the Labor Department reported Wednesday, in another sign of slack in the labor market. The department closely watched job opening and labor turnover survey, commonly referred as JOLTS, showed that available position fell to 7.67 million on the month of 237,000 from June's downwardly revised number and the lowest since January 2021. Now, of course, the expectation was 8.1 million, so we're, 500,000 here off the mark. And this, of course, has been creating worries. And you would think, oh, that is bad for the market. Absolutely not. No, the market, well, it was up. Now it's sold off a little bit, but it was up a little bit earlier. But definitely not what you would expect from a miss like that. And of course, we are in psychotic land here for the market. And bad news is still somewhat of good news. And of course, if the job market is softening, that's going to force the hand of the Fed to drop rates and maybe drop them even more than what the market expects, which of course would be good for the market, or at least market participants seem to think it would be good for them, but maybe it could be terrible and the market could be wrong. Now let's have a quick look at the second article here about the bond market and the yield curve that has been un-inverting. Let's see what they say. The relationship between the 10 and the 2-year Treasury yield briefly normalized Wednesday, reversing a classic recession indicator. Following economic news that showed a sharp decline in job openings and dovish remarks from Atlanta Fed President Raphael Bostic, the benchmark 10-year yield inched above the 2-year for the first time since June 2022. And of course, we've been waiting for a long time for this inversion. We have to remind you that the inversion had been one of the most critical, the biggest one that we've seen in recent history. And if this is a signal for sort of the magnitude of the recession that could be happening after an inversion, then this doesn't fare good for the economy. What do they say here? The respective yields were both around 3.79 on the session, just a few thousand percentage points separating them. Let's move now to Twitter here, and let's look at what people are saying about this inversion of the yield curve. Now, who is this guy? I cannot pronounce that name. I don't know who he is. One of the longest yield curve inversion in the US in the past 40 years seem to be coming to an end. The chart shows the difference between the 10 and the 2-year when the yield curve is inverted. This difference become negative. Yes, it's one of the biggest recession incoming, ask Market Maestro. An inverted yield curve occurs when the interest rate on the 2-year Treasury bond, except the 10-year, historically, after the situation occurs and the Fed cuts interest rates, recessions have followed. And, of course, let's have a quick look at the graph here. And you can see here the recessions in pink. And, it's always sort of the same scenario. The Fed keeps the rate high for a long time, and it basically just destroys the economy. And when the yield curve here in blue un-inverts, meaning it goes back above the zero line here, as it did here in 2000 and 2009, briefly, of course, during the COVID crisis here, but that was a different situation because there was a pandemic, and it wasn't really part of the natural economic cycle. But here we can see that if we're following the same events, then we're un-inverting here, and the scenario repeats again, and we can expect then Fed rate that's gonna collapse, and the inversion of the yield curve progressing, and of course that would be very bad for the economy, for the employment market, for the stock market, for everything. It will be a dramatic recession. But let's see a little bit of what other people have to say. Mohamed El Arian here, also noting about 3 hours ago that the 10s and the 2 are disinverting. And let's see, there was one, I'm not sure, what is Luke Groman saying here? The last time the US yield curve uninverted with US debt to GDP at 123%, US deficit, GDP at 7%, blah, blah, blah. Central bank not having bought any USD in 10 years, but insurance different this time. Okay. Gareth Soloway, yield curve flips positive. Longest period in history of an inverted yield curve comes to a close. Historically, an inversion has signaled the beginning of a recession. Of course, hinting maybe that since this is the longest period of inversion, then it could be the longest recession. Who knows? But what could be the reaction of the Fed if that was to happen? I was looking for a chart here, but I'm not sure. I think it might be gone. Let me see if I can find it. I don't think it's going to work out. But basically, that was following sort of what Gareth Soloway was saying, and it was a chart that was going back all the way to 1929. And that also showed that the inversion that we are having is essentially the deepest inversion since 1929, and apparently the longest one ever. So if, Paul Krugman, let's see what, well, that was a long time ago. But this doesn't feel good, and here is a funny article here from Market Watch. The yield curve just turned normal. It's a positive sign for stocks. So we've had, everybody commenting here exactly the opposite. But of course, the mainstream media and Market Watch here pushing a narrative that goes totally contrary to sort of common wisdom and what everybody is saying. And let's have a quick look here at this article. It's not very long, but you will see that they actually provide no fact whatsoever that would support this title that this is a positive sign for stocks. The so-called yield curve has been sending an ominous message about the economy for more than 2 years, but now it is looking healthier. un-inverting, but it's not really looking healthier if this signals the beginning of a recession. Yield on the long-term bond are ordinarily higher than on the short-term because investors demand higher return to cover the risk of inflation. But from 2022 through Wednesday morning, that relationship has nearly always been reversed, leaving short-term yields above those of longer-dated debt. That matters because an inversion of yield curve, a sharp plotting to return of debt of various maturities, historically has been a sign that a recession is on the way. So they're saying that's a bad sign, but they're still tiling it's a good sign. The yield on the 2-year treasury debt, well, we can skip all that. But basically, they don't tell you anything. They don't give you any reason as to why that would be a positive sign. They just say in the title, it's a positive sign. And yet in the body of the article, they're going to tell you, the common wisdom and what everybody knows, that when the yield curve un-inverts, it's the beginning of the problems. And that's usually a signal for recession. And all the recessions that we've had in modern history have all been preceded by an inversion and then an un-inversion of the yield curve. And yet, somehow, without any fact, without any evidence, without any argument, they are putting a title that totally contradicts the body of the article, saying it's a positive sign for stock. They're not offering absolutely any evidence of that. And, essentially they're lying to you, by Jacob Sonnenschein, Jacob Shoeshine, maybe when the shoeshiner is giving you tips on stocks, it's probably a sign that the market is topping. Now the next news of today, it's Dollar Tree plunging 20% after the discounter cuts full year forecast. Not looking good here for Dollar Tree. And last week, we were talking before the earnings report of Dollar General, sort of talking a little bit of what these earning reports for, discounters means for the economy. And now we're seeing Dollar Tree plunging. Dollar General last week reports were also bad. And so we're seeing the lower end consumer really struggling. Now let's see a little bit of what they're saying here. Shares of Dollar Tree fell more than 15% in early trading Wednesday after the discounter cut its full year outlook, citing increased pressure on middle income and higher income customers. And let's have a quick look here at the chart of Dollar Tree. And you can see it is going straight down here, looking bad for Dollar Tree. We're on a daily chart here. So from the top here, that was in March. Now we're down like 55%. So it's been a bad year for Dollar Tree. It's been a bad year for discounters. And of course, we're sort of seeing this K-shaped economy where the higher end customer is doing pretty well. The higher end consumer is getting, high return, 5% on their cash, adding to sort of the money that they have to spend, while the lower end consumer is getting 20% APR on their credit card, and they're already tapped out of cash. So of course, the lower end is going to be dropping dramatically. And here we can see Dollar General now down 24% on the day. Quite dramatic drop here. And, this could be just the beginning if the un-inversion of the yield curve turns out to be what people seem to think it is, and if we're going now into a recession, and we'll have to see. But on Friday, we're going to have the U.S. employment reports, And this is going to be, what's going to move the market. Now, today, despite this JOLT report, the market's staying, sort of muted, not moving really that much up or down despite the news. But on Friday, 8:30 a.m., U.S. employment report, unemployment rate, and this is going to be the one that's going to move the market. We're going to see here, we have expectations. Which one is the expectations? The forecast. Forecast is the left one. So forecast at 161,000. The previous print was 114. Are we going to see once again a huge miss on the U.S. employment report? And if we do, then you can expect some reaction of the market. But we'll have to wait until Friday, 8:30, to see what it is. And last one here, the debate between Trump and Harris have agreed on the rules. So on September 10th, next week, don't miss out. We'll be covering this debate on ABC September 10. Trump and Harris will have mics turned off when the person is not speaking, so no possibility for any of the candidates to sort of filibuster and prevent the other one from making their argument. What do they say here? They're just talking about a copy of the rule was provided to the Associated Press on Thursday by a senior Trump campaign official in the condition of anonymity ahead of the network's announcement. The Harris campaign on Thursday insisting that it was still discussing the muting of the mics with ABC. But apparently it's not going to happen. We'll have to wait and see anyway. Thank you guys for watching this video. Don't forget to subscribe to the channel and don't miss out on our future videos. And I will see you on the next one.
Hit me with that like and sub to the channel. Hit me with that like and click the effing bell. Click that little right. The algo recommends. For sure you gon' like. The algo knows you well. Hit me with that like. Subscribe to the channel. Hit me with that like and click the effing bell.